Okay, the Michigan business tax probably won't be related to too many of your clients, but I'm just going to throw it out to say that it's being changed to something called a corporate income tax effective Jan 1, 2012. So if you got any clients in that area, check it out. And check the notes too, because it talks about the difference between the MBT and the CIT. Now, you're going to have clients that have employees working in the USA. And so you're going to need to go to this technical interpretation in your notes for Canadian employees working in the USA, May 3rd, 11, by Karina Podar. A Canadian company was providing services in the U.S. for a minimum of 180 days within a 12-month period. And CRA said, you know what, the Canada-U.S. tax treaty could easily deem that corporation to have a permanent establishment in the United States under Article V5 or V9, and the corporation as a resident candidate is taxed on its world income here. However, it may also be liable for tax in the U.S. on profits attributable to this deemed permanent establishment. Now, there'll be foreign tax credits available, but also it notes under Article 15, that's XV in brackets 2, if an employee, one of your employees performs services in the U.S., you have to tell them, if they've been there for more than 183 days, that he or she are maybe liable for the United States, for tax in the United States, and have to file a U.S. return. That's assuming the remuneration is over $10,000. So all of these issues and related matters were discussed in a 5-page technical interpretation. Now, we also have another one, January 4th, 2011, technical interpretation. And CRA are responding to an inquiry about the notice in subsection 116.5.02 of the Act as to whether it should be sent to CRA by a purchaser. So your client is in Canada and they are purchasing property from a non-resident. Now, if you're acquiring property that the purchaser considers to be treaty-protected property, so there is no gain on it, from a vendor to whom the property purchaser is not related, then CRA agrees with the taxpayer's view that it is treaty-protected property, it's treaty-exempt property, it's excluded property, and even if the purchaser does not give this notice to CRA, which, by the way, has to be filed within 30 days of the acquisition, it's still tax-free. But CRA said, you know, you should probably still send in the notice, and the taxpayer said, why? And CRA said, because if we do an audit on this and determine that it's not tax-free under the treaty or whatever, then you could be subject to penalties. So in such a case, if you have filed this notice under 116.5.02 and you've made attempts to determine that it is tax-free and it turns out it isn't on an audit, you're still okay because you've met the requirements of 116.5.01. So the fallback or safe position is to send the notice in anyway, even though you feel that it's tax-exempt property, just in case it isn't, to protect yourself in that eventuality. There you go.